Good afternoon, everyone, and welcome to Yerba Buena Financial Partners Q4 Outlook webinar. Thank you so much for joining us today. My name's Holly Ferguson. I'm the Director of Client Services here, and I'm here today with Bruce Frankel and Andrew Zittell. Unfortunately, Marilyn Suey is unable to join us today. She is traveling. Before we get started, I wanted to just run through a couple housekeeping items. First, if you have any technical issues, please contact Katya at our main number, 415-334-8000. Again, it's 415-334-8000 for technical issues. And if you miss Q3's Outlook webinar and want to find out more about what happened in the first half of the year, feel free to check out our website under the Events tab. You'll be able to find that recorded version of our webinar there. The agenda today, we are going to be talking about, or I should say Bruce and Andy are going to be talking about economic events in the third quarter, how they've affected our investment models, and what we're watching going forward. We'd love to take your questions at the end, so I will unmute the phone line so you can feel free to ask any questions you like. And if we're unable to get to your question, please send it to me or call us or email us, and because we want to make sure your questions get answered. And then lastly, an event survey will appear on your screen after the webinar, and we'd greatly appreciate it if you'd fill that out because we do use that feedback to try and improve our webinars going forward. So once again, thank you for joining us, and I want to review our mission statement before I hand the call over to Bruce. We work with select clientele to guide and empower them to make informed decisions regarding their wealth. We provide our clients with the ability to make a significant positive impact on their lives and the lives of the people and causes they care about deeply. Our proprietary process is called the Wealth Impact Process, and this is a disciplined approach that we have created to provide our clients with personalized service of the highest caliber. At this point, I'd like to introduce Bruce Frankel, the Managing Partner.
Thanks, Holly. Great job. I feel like sometimes we're boarding an airplane and we have to go through in case cabin pressure changes, and right?
Thanks a lot.
So, no, kidding. Thank you so much. We have to do that.
I like the little hat, Holly.
No. Okay, so we're keeping a similar format that we've done in the past several quarters, talking about what we saw this past quarter, what we're looking at today, and then what we're thinking about going forward. And this was a challenging quarter, as you're going to see, that challenging for a couple of reasons, and us to prepare for this webinar. Everyone around here has been working very, very hard to put this together for you. Our goal, by the way, of doing this is just to increase our communication with our clients and to increase the transparency of what it is that we're doing over here. This quarter, as I mentioned, was particularly difficult to put this together because of the shutdown of the government. Now, the government was 86% operational through this, I think, 17-day period that the shutdown occurred. However, a lot of the economic data that was supposed to come out that we rely upon to put this together for you did not. So we were waiting, and then that brings us up against compliance issues because everything that we do must go through our compliance department and our research department. And so up until about a half an hour ago,
right,
we were still working with our compliance department on a couple of slides that you're going to see here. So we think we put together a good presentation for you, and we'll give you a nice update.
Hence, we have the negotiated settlements with compliance.
No, yeah. So as you know, we like to talk about some of the terms that pop up from time to time in the world of economics. So one that keeps popping up, if you listen to any of the news and business cable stations, is talking about this idea of synthetic growth. So multiple choice here. What is synthetic? What does this word mean? Phrase mean, it should say. the process of artificially growing matter in a test tube, synthetic growth, maybe a petri dish, I don't know. A technique used by bikini models. That's the politically correct portion of our presentation today, synthetic growth. A term used to describe economic growth propped up by a central banker's monetary policy. And of course, the answer is C. We're going to talk more about this and how the continued actions of not just the United States Federal Reserve, but the worldwide central bankers is providing market growth. It's been unbelievable market growth, quite frankly. All right, so we talked about our basic agenda. First, let's look at the past, this past quarter. Actually, these numbers go through September 30th. The S&P 500 for the year is up, let's just call it 18%. The Dow Jones Global X US, so this is all foreign stocks, that index is up 9% year to date. So far off the US market. The 10-year Treasury at this point was 10.66% for a 10-year yield. And gold futures, actually spot gold prices have gone down just about 21% for the year. Compliance asks me to point out that indexes are unmanaged and cannot be invested in directly, but these are the numbers for the quarter. Some expert opinion, some commentary that came out that we thought was apropos for you to help put things in perspective. Art Cashin, one of the what do I want to say, paternal gentleman of the New York Stock Exchange, has said I do worry a little bit that we're in the beginning to hear things that are reminiscent of the 1999-2000 period, where we're talking about the number of hits and the number of eyeballs on some of these websites. And he's referring there to what's going on, again, in small startup-oriented companies, especially technology companies, especially coming out of Silicon Valley. And we will talk more about that in a little bit. But that's our concern. We kept this in there from last time, as you see in January, so we want to see how well this comes true by the end of the year. Bill Gross, the head of PIMCO, largest mutual fund company in the world. In January, he said he's afraid there's going to be ashes in our stockings this year. So we're coming up to the holiday season, and that applies to all asset classes. Bonds are priced not just for perfection, but with close to 0% yields. The juice has been squeezed out of the orange, according to Bill Gross. Andy?
Yeah, another way of saying that, William Cole, the head of fixed income investments for Putnam, the other night, said that what we have here in the bond market perhaps is return-free risk, was another way of saying that, when we always think of risk-free return, where we're looking for a good deal. But he just flipped it around, saying it's not such a good deal, and we have to be very, very cautious where we go in those markets.
And as interest rates go up, one of our big concerns here is what's going to happen to people who are in quote, unquote, conservative investments, aka bonds. George Friedman, he runs Stratfor, a geopolitical kind of watchdog, what do I want to say, investigative reporting website. They do great work, very interesting. George Friedman said in July, we have gone from China, the omnipotent, the belief that there was nothing the Chinese couldn't work out, to the realization that China no longer works, according to George Friedman. So we'll be touching on that as well in a little bit. Here's the chart of the S&P 500 from the end of the second quarter up until early October. If I would put it up where it is now, that line would be swooping up again here at the end, if you can see my cursor. Since the preparation of this presentation a little bit more than 2 weeks ago, we now see the markets in record territory again. So average, this statistic on the right in the last bullet point there, does that necessarily mean that there's nowhere to go? Well, that doesn't mean that. first of all, no one knows where it's going to go. We can't say based on past performance where anything was going to go. But there are statistics out there that support that the average rally following all-time highs is, on average, 28%. So we are watching that now very closely to see what happens, and especially as we watch the GDP numbers and the employment numbers, which we're going to get to here in just a little bit. Again, we carry forward the slides that are still apropos from the last quarter's presentation. We love this slide. Government, government, government are the big sandbags holding back the economic recovery that we have going on. We do have a little bit of recovery, but again, the consistent thing is the fact that we cannot have a long-term reliable fiscal and tax policy in the country so that people can move on. But we will talk about that more. But suffice it to say, we're still facing this drag on the economy of what our friends in Washington, D.C. are doing. Okay.
That last slide reminds me of a famous lyric, which is, I don't know, but I've been told the weight of lead is the same as gold. So in terms of holding us down, right? Some people see things as positive, some of us are seeing it as negative, but those things are definitely there preventing that balloon from taking off.
It's not happening. So then this slide here, we did have some cutback in government spending. And you can see what this chart is showing is what happens, because if there's a cut in spending by huge governments, well, of course there's going to be an impact on the economy. We here believe over time the economy will adjust and the money is better used out in the free market than by the government. But we can't ignore the fact there are ramifications of government cutting back in spending. And if you look at the United States in 2011, 2012, and 2013, this is the estimated impact that the cutback in spending has had. All right, so the source of the data is the International Monetary Fund, and this was put together by the Scowcroft Group in estimating that in 2013 we probably lost 2% of our GDP annualized because of the cut in government spending. That's just 2013 alone. So we will have to keep an eye on this going forward. Obviously, if we have very little or no growth, it's going to affect the rest of us here. GDP, so this brings us to it. 2% growth. The U.S. economy continues to grow, but at a sluggish pace as we begin the fourth quarter. So despite the pickup in pace of growth in the second quarter to 2.5%, measured by the GDP, growth will be challenged to reach even 2% here during the next quarter. This will affect the rest of the economy, employment, inflation, et cetera, but we need to see greater growth. I think everyone wants greater growth. The consumers have done pretty well. You know, jobs are being added, albeit very gradually. The housing recovery in the first half of the year has done great. Retail sales were chugging along near 4% growth rate. We have challenges ahead. We've seen signs recently that the retail sales are slowing. But throughout the year, I think that it's been overall pretty good what's happened on the retail side. The Federal Reserve remains very accommodated, maintaining bond purchases through quantitative easing throughout the quarter, but government spending, as we talked about in the last slide, has been down and has impacted things. So chain store sales, you can see, had a bit of or was up quite a bit in the first half of the year. We're seeing this tail kind of come down now at the end. And if you look right there. All right. The scariest jobs chart ever. Now, I know there's a lot of lines here, but all the lines represent the different years and what happened to employment as a result of after recessions. So percent of job losses in post-World War II recessions, right? So we go all the way back, and if you see the red line, which represents our current, quote, recession, or coming out of the recession, how elongated this line is, how spread out it is, when these others come back with quite steep slopes. The 2007 recession is very elongated. So the percentage of job losses that we're getting back is just not happening.
It's 2 years difference in time.
2 years difference
between that and the 2001 recession.
Yeah.
That's a lot of months of additional
unemployment. It's still going, right? So. All right, so that's the scariest job chart in the world here. We have gained a little bit in the U.S. Again, if you've been on previous webinars, you've seen this chart before out of Jobonomics. We love to watch that. Unfortunately, the pace of improvement in the labor market matches the sluggish pace of the U.S. economic growth. After a strong first quarter, over 200,000 new jobs per month were being created. The pace of that has slowed down markedly. The last couple of job reports have just not been very good. And as you can see, the growth in jobs is not going to surpass what's needed just based on demographics in our society. This next chart, again, we show this on a regular basis at our webinars. And this is showing participation rate. We believe here that we watch the unemployment number with some skepticism. We give a lot more credence to participation rate. How many people that are ready, willing, and able to work are working to the extent that they want to be working. And what we have here in the middle, this black cube block here, is 91 million people not in the labor force. They can work, but they're not looking for work. So they are what gets classified as the people who gave up. So that means that financially the growth in the economy is being supported by 33% of the population. And that's just not sustainable. That goes all the way back to post-World War II, or I should say 1970 lows. So we're talking about 40-year lows.
Yes, and as we were talking about yesterday, even though what this doesn't account for necessarily is the baby boomer retiring generation and those people who aren't working, it's still, even if you add that 33% of the private labor force with approximately 10% of the government workers, it's still 40% of the 41% of the population trying to support every other American. And those are just difficult numbers.
And just to be clear, the 91 million number, where the 33% is based off of, is taking into account people over 65. So if they are in the retirement phase of their life, they're not included in this number. So it is accounted for. All right, so the big surprise of the quarter came when Ben Bernanke and the Federal Reserve decided to not taper after messaging the market since April that they were very strongly looking at tapering. This was a big surprise, and it's really, I do believe that the Federal Reserve, when they say that they are looking purely at the data, and the data hasn't been good. So they want to keep providing the stimulus into the economy, liquidity into the economy, or put another way, the silicone into the economy to provide us with this synthetic growth. So what else do we want to say here? I mean, this surprised the market a lot, and being in silly season, the term that I introduced to us all last quarter, being in silly season, the market saw this as an opportunity for more growth. Silly season we define as good news is bad news and bad news is good news. So bad news in the economy means the Federal Reserve is going to keep its actions going. which the market likes because it helps the stock market grow. And come the day when tapering really happens because of good news in the economy, well, we will see the stock market most likely take a dip. All right, another crazy chart that we wanted to show you is showing inflation. And part of the Federal Reserve's dual mandate, on one side is the labor market, on the other side is inflation, and watching out for there to not be high inflation. Now, as you can see here, this is also pointing in the red line. We have the headline number of inflation, and then the blue line is core inflation, which takes out food and energy. The reason they take out food and energy,
we don't drive it and we don't eat.
So why do they take out food and energy? It's to try and remove the most volatile elements of the economy in order to try and get a gauge on a moving average over time rather than any spikes from any of those volatile things. So you can see how close now we are correlated. The headline number to the core number. If you go back and look at periods of time where there's been big divergence, you can see that coming were not so good times afterwards. So we like that there are high correlation in those two numbers. What we don't like is the fact that there's virtually no inflation. Even updated since this, we talked, their inflation numbers have come out of being 0.7%. So most of us say, well, that's great, prices aren't going up. Andy, you brought up a great point yesterday.
Yeah, we were talking about the Federal Reserve or the central banks in Europe as well, and the accommodative policy and the potential backlash of, like your comments on this, Bruce, of creating a deflationary environment.
Right.
And how insidiously devastating that can be in so many different ways. You asked me the question, if you were thinking about buying a new car, right, and you're in a deflationary environment, you're going to buy your car now or you're going to wait. So I wait. Well, follow those tea leaves. Right. And we kept going, and then you wanted to talk about Japan as an example.
Well, I mean, just that one instance, people ask, why is deflation a bad thing? It's way worse than inflation. So that's why we're bringing it up here. So deflation's a bad thing because of like what Andy said. If you know prices are going to be cheaper in the future, you're going to put off your purchase. Now multiply that by hundreds of millions of people across the globe and what that would do to the economy. People would lose their jobs. The unemployment would be horrific. It would be a terrible thing. People would be lowering prices in order to just compete and stay alive.
Manufacturing slows down.
Yeah, and that cycle really becomes a whirlpool. Now, Japan has suffered with deflation, for 20 years. So now what they're doing is taking the experiment of the U.S. Federal Reserve, and we have to say it's an experiment because exiting, and we're covering some material that's meant for later, but it's okay, exiting for the Federal Reserve is going to be an experiment. They don't know what to say. They don't know how to do it. They're purely coming up with it right now as they're doing it. Deflation is what Japan faced. That number, 0.7% inflation, was actually Europe's number here from the last period. And they are very concerned in Europe about deflation. Japan is fighting it by purposely devaluing their currency. And we have the potential to see a currency war around the globe now for others to keep pace with what Japan is doing that is unprecedented. But Premier Abe of Japan has decided that he is going to be very aggressive and devalue the currency at the same time they're pumping huge amounts of money into that economy to finally get it to turn around. And they're starting to see signs of it to actually work. So they're starting to get some inflation back. They're starting to get some growth back. But this all has to be watched, right? Because it doesn't happen in a vacuum. And if they're devaluing their currency, then others say, well, we need to do it. Indonesia says they need to do it. And China says they need to do it, and
global
the U.S.
currency
says they need to do it, and everybody else has to do it. So there we have it. All right. That's inflation. One last graph on inflation. By the way, this website, usinflation.org, is very interesting. They have all kinds of statistics for you to look at and compare things to and play with. But you see the trend here, what's going on with our inflation in the past couple of years. This is not a good trend. We need to see this get back up here in the 2-3% range. Our interest rates did stabilize now that you took that other chart out. Okay, interest rates did stabilize now. Commodities have had just a very, very difficult time. A very volatile third quarter. Ended with small gains in the broad commodity index of 2.1%. Commodities began the quarter with modest gains against the backdrop of a reassuring emerging market data, some growth-driven inflation concerns, and a weak U.S. dollar. But the group took a very bumpy ride. Oil and metals markets have reacted to events in Syria, which swung everything straight up in the quarter, and now that those things seem to be stabilized, it brought them right back down. So that's a good news, bad news story. Let's start with the bad news. The bad news is we were just talking about it. That has the potential to create deflation in the economy. The good news is it's a tax break, right? Gas prices are going down. Now in California, especially the Bay Area, I think I saw where we have the highest gas prices in the country and are amongst the highest prices of the top 50 real estate broad markets. The Bay Area is like in the top 10 or 11 of that. So energy prices coming down makes gas cheaper, puts more money in people's pockets that they hopefully go out and spend, and we keep that like that through the holiday season, and we have the retailers have a good Christmas season, then that's all a good thing, right? Interest rates, well, this is the crude prices, so we just spoke to that, heading down. Okay, our models. So we get into our models now. All right, so I have to say, so what we use here in the model we're going to represent is a model that is of our most used models, right, or most used asset allocations. We manage 6 different strategies that we then meld into a portfolio for a client depending on the client's situation, their age, their risk tolerance, the purpose of this money, how long it will be there, et cetera, et cetera. All that's right for them. That's right for them. We picked this overall mix of our strategies that we call the YBFP Global Growth with Income Sector. It's a moderately aggressive portfolio that's allowed for us to go up to 60% on the equity side and 40% on the fixed income side.
A lot of people would equate it to a balanced type of allocation.
Right. Okay. So we have 25 overall asset allocation models, and we don't have time in this webinar to go through all of them, right? So, but if I have to explain it like that every time, maybe we do. No, I'm just. Okay, so what you can see at the beginning of the year here, we had quite a bit in cash. Green is cash, red is fixed income, blue is equity. So this is the end of December 2012, and you can see we had quite a bit, 40% of the overall allocation was in cash. That changed over the first quarter, where we were fully invested, 60% on the equity side, 40% in fixed income. All right. As we went into the second quarter, interest rates were going up, just to remind everybody. And in a rising interest rate environment, we do not tell clients of YBFP to just ride the roller coaster ride of their bond portfolio and suffer through that. We will get them out of the bond portfolio at some point. There's no panacea in that strategy, I have to say. It is not an hourly thing we watch, but over time, this is how we manage money. So you can see the reduction in the red and the increase in the green, increasing cash in the model and reducing our exposure to fixed income.
We also reduced our equity exposure with the concerns as a result of the rising interest rates. You could see that as well.
There was a pullback in the market overall, and we did exit some positions. Now, as we went into the third quarter, we increased our fixed income, but mainly in inflation-sensitive positions that we use to benefit from a rising interest rate environment.
An extremely short duration.
Very short duration. So at the end of the quarter, we did increase and get back into some of the high yield, which is going to be reflected on this next slide. All right, but this takes folks through where we are year to date. And yes, Sandy.
No, I was going to say, let's do the next slide.
Okay. So here's the next slide, and this is a doozy to look at, we realize. This whole first section here, as I'm panning over, all the way up until this big one here, these are all our different equity positions. There's 23 potential equity positions in this strategy. And you can see the only one where we're completely flat is this is as of October 30th, we just exited real estate towards the end of October. Had quite a bit good run up in it and exited. We just recently re-entered gold. So you can see at about 2.5, 2.75% positions in all of those equity holdings. Now over here, you can see our investments in corporate income, high yield, as Andy said, and then floating rate and inflation are the ones are positions that we use to benefit from the increasing interest rate environment.
Right.
Andy, do you have anything to say? And I'll take a drink of water.
Well, just that we have also, since this slide, we have increased our exposure to certain municipal bond holdings, seeing some opportunity there as well. But,
yeah, and it wouldn't be reflected here, right? This is not our muni strategy. All right, so we're pretty fully invested right now. Some of the bond areas we're still staying away from, and we will wait. We will see. All right, so that's it on the models for now. Holly?
This is our intermission. If you are a client and have not met with Andy and Bruce in the last 12 months, please call me to set up an annual review, because it's really important that we talk to you about your portfolio to make sure that you're on track to where you want to be. And so feel free to call me, email me, and let's set that up if you haven't already. Or if you need a second opinion, or you know someone who needs a second opinion, please feel free to call us for an initial assessment. I also want to make sure everybody knows that we have moved. So we are now in San Rafael, and we have a beautiful office building on 5th Avenue. And we're going to be having an open house on December 4th at 5 p.m. And so we'll be sending out some invitations and via email regarding that. So we hope that you will stop by and see our new digs.
Great. Thanks, Holly.
Thanks, Holly.
All right, let's look at where we are now. These are the things that are top of mind with us. The Federal Reserve, signs of the consumer shifting in their purchasing habits right now. Home sales are dipping. Our politicians haunt us. We're trying to keep Halloween alive a little longer here, so you'll see some Halloween themes. as a, this was us looking at the third quarter. So as the time we wrote this said stocks trading at just below all-time highs, they're really at all-time highs, and talk about the Affordable Care Act. We can't let you get away without talking about the Affordable Care Act. All right, so Janet Yellen, the former San Francisco Fed governor that we know from around here, is now the current vice chair of the Fed, nominated to be the chair of the Fed. Ben Bernanke is stepping down at the end of the year. Whether Ms. Yellen is approved or not by the Senate, she will be the new chair because once the...
It's the transfer of power.
Yes, so
protocol.
She will be. Hopefully it's a smooth transition. She gets approved easily. We're not expecting any big change in policy from Ms. Yellen, from Ben Bernanke. If anything, her history tells us she's more accommodative, so we could even see more liquidity in the markets, as well as she too, like Ben Bernanke, has this huge fear about deflation. And then if you read any of her writings, this is top of mind for Ms. Yellen a lot.
So what is her full name again?
Janet Yellen.
Janet Yellen.
Oh, we didn't put her name up there at all?
No.
Okay, Janet Yellen. All right, kind of a shift going on in spending habits. Auto sales. The U.S. auto manufacturers have the story is a great story. So here, looking at this, it's talking about auto sales October 2013 versus October 2012 and the change, and year-to-date numbers and change from year-to-date last year. So let's just look at year-to-date numbers from last year. What's going on? General Motors, Ford, Toyota. Toyota and Nissan, great comebacks after the earthquake and tsunami there, so they seem to be coming back. And they're actually opening more manufacturing plants in the United States. So we're starting to see more and more manufacturing actually shift back to the United States. Chrysler, Honda, Hyundai, and Volkswagen. So the big numbers here that we're seeing big time from U.S. U.S. car manufacturers, and there's some good news out there in the economy with this, as well as this number as it relates to auto purchases. So this chart shows over time, going back to 1995, the growth that has occurred in the age of our cars and trucks to where it's now almost 11.5 years.
They're driving them longer and holding them longer.
They're driving, right. So a couple of reasons that we think for this. One, they are just built better, and they last longer. Two, through recession periods, it's very common to see people repair their cars and not replace their cars.
Right.
So we're seeing, there's an analyst with Lazard by the name of Jennifer Davis. She gave an interview in October where they're talking about there's been a shift away from spending on apparel and other discretionary items and a shift towards purchases of homes, automobiles, and in the homes side of things, the durable goods that have to go in a home, right? Appliances, washers, dryers, furnaces, big ticket items.
So given this slide and the previous slide,
Yeah.
if one was to project this chart forward, we should see that line leveling and then coming down a little bit as new automobiles begin to, as people make those purchases.
We would think.
Yeah.
Yeah.
Assuming we don't have that deflationary environment.
We'll try and start to, I find this an interesting chart. We'll try to start to include this quarterly to show this so we can see if that trend really emerges or not. You know, we're big trend followers here, so I'd love to do that. Now home sales. We have to talk about home sales. Home sales have been going just gangbusters, and after hitting the highest level in nearly 4 years, existing home sales declined in September. There was limited inventory. That continued to pressure home prices in much of the country, and that includes the Bay Area. Total existing home sales, which are completed transactions that include single-family homes, townhomes, condominiums, and co-ops that are publicly listed. According to the National Association of Realtors, that declined by 1.9% to a seasonally adjusted annual rate of 5.29 million homes in September from the previous month of 5.39. So seeing a bit of a dip. It's 10.7% above the 4.8 million pace of 2012. So year to date, great number going on, but we're experiencing a bit of a dip. Now the Bay Area, it's hard for us to compare here because when you pull up prices of the rest of the country, right, we're talking about, I'll show you the next slide, but
we're in one of the most expensive real estate markets in the United States.
Oh, it's not here.
And cycles are slower here. I mean, faster.
Faster. So according to Mark Machado, a friend of YBFP, a real estate agent with now Coldwell Banker, formerly with Frank Howard Allen in Marin, according to Mark, it's generally considered a buyer's market when less than 25% of listings are in escrow. A balanced market is when 25 to 40% of listings are in escrow, and a seller's market when 40% are in, when more than 40% are in escrow. So in Marin County, where Mr. Machado mainly operates, here's the statistics through September. For homes up to $500,000, it's a very strong seller's market with 56% of all homes in escrow. For homes from $500,000 to $1 million, it's a seller's market, also with 50% of the homes in escrow. For homes over $1 million, it's a balanced market with 27% of homes in escrow. So a huge difference. But still, seems to be pretty much overall a seller's market, and there you have it. I think this is, so we have to watch what's going on with our politicians. We're equal opportunity political dissers here. So don't get offended if one of your political persuasion is not represented, because we're going to slam both of them. So feel comfortable. But again, the Halloween theme. We had this issue in 2012 as well, 2011 as well, of us having to worry about these folks not getting along and cannot make decisions. And we have threats of government shutdown, and we have threats of not raising the debt ceiling, and we have all these issues that go on in the with our politicians that prevent us from moving the economy forward.
Right. So Bruce? So yeah. What's the difference between Halloween and our government leaders? Is that Halloween only haunts us once a year?
Right.
We've seen this movie before and over again.
Well, listen to this. So it's really interesting. I found this quote. And I take this quote from our weekly market commentary. If folks on the phone don't get our weekly market commentary, it's a wonderful 5-minute read every Monday morning that we send out from here, and you can contact Holly to receive it. But we quoted in there, think about this, since the rally began in March 2009, there has been a flash crash, a Greek default drama, the U.S. debt ceiling debacle, the Standard & Poor's credit rating downgrade of the U.S., the sequester, the Great Taper Scare, more debt ceiling debacles, budget fights, tax fights. Each of these, we were told, could have ushered in a new bear market. But instead, the S&P 500 squirmed out of the traps and headed higher. And for its latest trick, the market had to avoid the double whammy of a government shutdown and the potential default at the same time. So now we have a short-term solution, but we're in the section of what are we watching now, right, in this webinar. And this is a huge thing that we are watching, because these folks here are supposed to be negotiating right now. From this little cartoon talking about sequester, debt ceiling, and the fiscal cliff going through the conveyor belt of Congress, and there's the workers on top. One says, working hard or hardly working? And the other guy says both. well, they're working hard over there in Washington, maybe, but they're not getting anything done. And then this one from Halloween, where unemployment comes through the window to Barack Obama's bed and says, boo, unemployment, and I'm still here, which is our biggest concern. All right, so going forward, we're watching this Fed exit thing, so you can see a lot of common themes. A lot of these themes are common from last quarter as well that are still playing out. The China economy, Europe, what's going to happen over there, money flows, I think we'll move along, we're running out of time. We already talked about political risks and unknowns and uncertainty. We talked about what's going on overall with the Fed impact on the financial markets. We thought this was an interesting chart. With interest rates going up and up, it makes it more difficult for people to buy a home. So you can just see these are the different types of rates ranging from a 1-year adjustable to a 30-year fixed mortgage. And you can just see the separation between the 30-year fixed and the adjustables, or the shorter terms. You pay quite a premium to have that.
And 100% basis point or 1% increase in that 30-year fixed.
100, yeah.
Just over the late spring.
Yes.
Spring alone.
So it's dipped back down a little bit, but not very much. We used this chart in the last quarter as well. This is where it gets difficult to use national numbers about home purchase prices, but it does impact one's ability to afford a home. So this is showing at different interest rate levels what the different payments would be.
Yeah, and a $500,000 mortgage, for example, they're a little more than a $500,000 mortgage. A 1% interest rate increase translates to $300 a month.
And when you look at an annual difference of $12,000 and then life of the loan difference, this takes affordability out, or makes affordability more difficult. We sell less homes, less things are bought to go into the home. It's all a part of the same cycle. All right. China. China saw a bit of an uptick this last quarter. It's no longer the 10-11% China. What we're looking at is more of a 7 to 8% China. China's economy has expanded at 2.2% quarter-on-quarter rate. That's 7.8% year over year from the previous year. The gross domestic product figure matched the median forecast, so it didn't surprise anyone. So that's a good thing. Analysts are questioning whether such measures can be continued, and some signs of recovery is waning. And according to a gentleman at HSBC Bank, quoting here, the GDP figure in the fourth quarter may be lower than the third quarter as the momentum of rebound is not that strong, while the base from the fourth quarter last year is relatively high, right? So comparing year on year is what he's saying is going to be really difficult for China. Even more difficult for China is the real estate market over there. 60 Minutes did a recent story about China building ghost cities. Now, as we built this, we could have gone in and picked a number, and maybe we should have created a collage, a number of these cities fully built. You can find them on Google Earth. Fully built, complete with vast complexes of office complexes, skyscrapers, government buildings, apartment buildings, condominium complexes, all of these things, but there's no people. The streets are empty, and so they have built this and built this and built this to keep people employed. A lot of these units are actually sold because that was the dream of home ownership, real estate ownership, and what have you that was sold, and they sit empty. So how is this going to be worked out? No one knows. Again, a big experiment. The concern is a huge bubble burst in the real estate market in China.
Yeah, I mean, China, I think, is they're looking to stabilize the disparity in high growth, low growth, and at the same time we have a lot of people that they are expecting. They're building this infrastructure. They've taken a long-term view, even though they've been dealing with short-term numbers, looking at a lot of people who are going to migrate from an agricultural society to an urban environment, and so they're putting it in place. We'll see what happens. Watch it.
It could be the ultimate putting the cart before the horse sort of a thing. Europe. Bloomberg News reported on October 21st an article called "Europe Breakup Forces Mount as the Union's Relevance Fades." This continues to be under the blankets out there of what's going on in Europe. And Lord knows we don't want Europe to rear its ugly head again, a la 2011, because all of these things that we're talking about represent uncertainty. It was one of our bullet items of continued uncertainty. We just think we need to create a more certain environment in the economy for business and for people. The unemployment rates are unbelievably high, 11, 12% unemployment rates. Unemployment of youth, of people 18 to 30 years old, double those rates. This continues. Now the fear of deflation. And personally, I think the biggest risk is interest rate risk. Because if interest rates start to go back up again, the southern European countries are simply not going to be able to pay their debt. Right. And so we are keeping an eye out on what's going on in Europe. Our political leaders, these folks here are supposed to be the primary negotiators for the Democrats and Republicans in Congress, and we just, what do I want to say? We wish them the best. We pray that they work together nicely, and am I just seeing pie in the sky?
Well, we're disappointed that they don't play well in the sandbox together.
Yeah.
Have not proven to do so.
Yeah.
And they're more interested, it seems, to be in politics and partisanship than they are in solutions for our nation as a whole.
And hopefully there are some statesmen left in the world, because really the people who will suffer in the end are our children and grandchildren who will have to pay these bills. So. All right, we are coming into the holiday season. And we always like to remind everyone, in the long run, everything will be okay. This is a great country. The people are unbelievable in this country, and we will get through whatever, but it's important to laugh. This year, Hanukkah falls on Thanksgiving. It's incredibly early. So we want to wish everyone just a wonderful holiday season, great Thanksgiving, great Hanukkah, great Christmas.
Thanksgiving Hanukkah? How did they say it? Someone said it?
But we want to remind you that you pay us to be here watching these things and looking out to be a caretaker and do the best we can to mitigate the roller coaster ride of all these things. There's things for us to look at and worry about, but there's also a lot of good news out there. And find a way to laugh, right? Every day, find a way to laugh. It's therapeutic. And I think
do you want to unmute the lines for Q&A, see if there's any questions?
You put me in charge of that.
If you don't have time to stay on the line with your question, please feel free to email us. You can, whatever email you have, I'll make sure it gets to the right person, or you can just send it to me at holly.ferguson@ybfp.com, and we'll make sure your questions get asked. And we appreciate you taking the time to spend with us.
And it's unmuted. Does anyone have a question? Yes? No? We did a great job. So there are no questions.
When are we going to do this again?
We are going to do it again. We are going to do it again next quarter.
Right.
Yeah, probably the second week in February because we have to wait till all the economic data comes out, and then we have to go through our compliance approval process. So that's about this was a tough getting this one out this early in the quarter.
All right. Yeah. Thank you, everyone. Thank you, Andy and Holly, for helping put this together this quarter. It was particularly challenging, and we want to thank all of you. Thank you for your business. We greatly appreciate it and understand the trust that is involved in doing that, and we respect that always. So thank you, and again, enjoy your holidays.
And fill out the survey that's going to pop up on your screen.
And we hope to see you at our open house.
Thank you.
Bye.